It is a Thursday morning in February. You are sitting at the kitchen table with your coffee going cold next to the laptop. You open your bank account and look at the same number you have been looking at for 31 years, the balance on the mortgage. You type in the final transfer amount. You hover over the confirm button for a moment longer than you expected. Because after 31 years, this is the last time you will ever do this. You click it. The balance goes to zero. You call your daughter. She screams. Actual screaming. Your son sends a voice memo that is 20 seconds of him saying the same two words over and over. Your neighbor brings a bottle of champagne across the yard at 10 in the morning. And that night, lying in bed, you feel something you have not felt since the day you signed those original closing documents. You feel completely, permanently untouchable. Here's what I need to tell you. You are not untouchable. You just made your single most valuable asset visible to the IRS, exposed to probate court, and vulnerable to a tax event that most CPAs do not explain fully until it is too late to stop it. You did not lock in your family's wealth. You created what estate and tax professionals call dead equity, money that looks enormous on paper and behaves like a landmine the moment circumstances change. My name is Chase Longwell, and for the next 10 minutes, I'm going to show you exactly how that landmine works, exactly what the detonator is, and exactly what you can legally do right now to defuse it before it costs your family somewhere between $60,000 and $120,000. Let me introduce you to Dennis and Carol Whitfield. Dennis spent 30 years in logistics management. Carol was a school librarian. They bought a 3-bedroom colonial in Mooresville, North Carolina in 1993 for $138,000. New roof in 2007. Kitchen renovation in 2015. Finished basement in 2019. In October of 2025, Dennis wired the final mortgage payment. Carol lit a candle. They went to dinner. By mid-2026, a formal appraisal on that house came back at $1,075,000. The Whitfields have approximately $900,000 of profit locked inside that house. And they believe they are protected because their CPA mentioned one number, $500,000. Section 121 of the Internal Revenue Code allows married couples filing jointly to exclude up to $500,000 of profit from the sale of a primary residence. For Dennis and Carol, that appears to work. They have $900,000 of profit. The first $500,000 is excluded. The remaining $400,000 becomes taxable. Painful, not catastrophic. They downsize and move on. Here is the problem. That calculation requires both of them to be alive. Carol passes away in the spring of 2027. Dennis is 71 years old. The house is too large. He decides to move closer to their daughter. But Dennis is now a single filer. And overnight, his exclusion drops from $500,000 to $250,000. The moment Dennis became a single filer, his tax protection changed. Without a letter, without a warning, without a phone call. His taxable gain increased by $250,000. Not because he did anything wrong, not because the market changed, but because the tax code changed the rules the moment Carol died. Add the net investment income tax. Add North Carolina state taxes. Dennis is now looking at a tax bill somewhere between $85,000 and $95,000 on the sale of the house he spent 31 years paying for, a house Carol helped him build, and nobody told either of them this was coming. But two things happened when Carol died that can completely change Dennis's position, if he knows about them in time. The first is called the step-up in basis. Under Section 1014, Carol's half of the home receives a step-up to fair market value on the date of her death. North Carolina is a common law property state. That means only her half resets, not the entire house. Carol's original half of the purchase price was $69,000. It steps up to $537,500. Dennis's half remains at its original basis. His new combined basis becomes $606,500. His gain is no longer $900,000. It falls to $468,500. After the $250,000 single filer exclusion, the taxable gain falls to $218,500. The number is much easier to manage. But the next rule is even more important. Under Section 121, a surviving spouse who sells the primary residence within 2 years of a spouse's death may still use the full $500,000 exclusion. Read that again. Dennis has a 2-year clock. If he sells during that window, his gain is $468,500. His exclusion remains $500,000. his taxable gain becomes zero. He keeps every dollar. No federal capital gains tax. That rule exists right now. It is not a loophole. It is not a trick. It is the law. And it only helps the people who know it exists. Miss the window and that protection disappears. Forever. Which brings us to something most people have never heard of. Community property trusts. 9 states operate under community property rules. In those states, when one spouse dies, both halves of the property receive a step up in basis. Not just the deceased spouse's share. The entire asset resets. That can eliminate capital gains entirely. North Carolina is not one of those states. But several states now allow couples to create community property trusts. Florida, Alaska, Tennessee, South Dakota, and Kentucky have statutes that make this possible. If Dennis and Carol had created one before Carol's death and transferred the home into that trust, the entire property could have received a double step-up. Dennis's gain would have been zero. His tax bill would have been zero. The cost of setting up the trust might have been a few $1,000s. The cost of not doing it could be $90,000. Here's what I need you to do before you close this video. First, pull your deed. Find out whether your home is held in joint tenancy, tenancy by the entirety, or inside a trust. The title determines what happens when the first spouse dies. If you do not know the answer, that is where you start. Second, calculate your adjusted basis. Take your original purchase price and add every documented improvement you have made. The roof, the HVAC system, the kitchen remodel, the basement. Every dollar spent on capital improvements can reduce your future taxable gain. Start gathering those records now, because a missing receipt today can become an expensive mistake later. Third, determine whether you live in a community property state. Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, or Wisconsin. If you do, the double step-up rules may already be working in your favor. If you live elsewhere, your planning window is still open. Fourth, if your spouse passed away within the last 2 years, speak with a qualified tax professional immediately. That 2-year clock under Section 121 does not stop. Every month that passes brings you closer to losing a tax benefit worth hundreds of thousands of dollars in excluded gains. The law gives you the opportunity, but it also gives you a deadline. And deadlines have a habit of arriving faster than people expect. Dennis and Carol Whitfield are a composite of real families facing this exact situation. Some of those families will sell during the 2-year window. They will owe nothing. Others will miss it, and they will write a check for $90,000 simply because nobody told them the rule existed. That is what makes stories like these so frustrating. The difference is not wealth. It is not intelligence. It is not even having a better accountant. Sometimes the difference is simply knowing that a specific section of the tax code exists and understanding that it comes with a deadline. Because once that deadline passes, no amount of regret can bring it back. If this gave you something to act on today, do one thing before you close this tab. Send this video to someone you know who paid off their mortgage in the last 5 years. Not tomorrow, right now, because the planning window they may not know about is already open, and these windows close without warning. Drop a comment below and tell me what state you live in and whether you own your home free and clear. I read every comment, and knowing where this community is located helps me focus future videos on the state-specific rules that actually affect your family. Subscribe and hit the bell if you want this level of detail without the fluff. And I will see you in the next one.